So here in this video we continue on from the from the previous video, and we had just worked out, we had extended the analysis, we had simulated the stock price behavior over and over again. We had done 1000, well, we had come down here to sell 1616, so we've about 1600 iterations or simulated paths, and then we worked out the discounted, so we discounted using 5% interest rate. We worked out a discounted intrinsic value of the option, and we used so here, for instance, the stock price, terminal price at the end of the path is 113. If we subtract away the exercise, that would give a value of 13. If we discount that at 5%, can continuously compound it, that would give us 12. If we took when the stock price was less, when the terminal stock price was less than the exercise price, the value of the option was 0. We did that about 1600 times. It's not a large number of iterations, but you can see we're not too far off. If I F9, this updates. I know from Black-Scholes model, if I have these parameter inputs, we can have a look at that. Let's use Black-Scholes just to make the comparison. So stock price of 100, exercise 100, risk-free rate 5%, no dividend yield. We'll change this to 1 year. We'll change this to 20%, consistent with our Monte Carlo model. And the value from Black-Scholes model is 1045. Now, we're still a little bit off, but if we run F9, we can kind of see that we get close. We're in that range. Okay, so every time, sometimes above, sometimes below, above, below, good bit below, again below. So there's a distribution of answers here that we get, and that's an issue with Monte Carlo, that there's a certain amount of error that's associated with the model. How we reduce that error is by just increasing the size of the number of paths. Maybe we would bring up to several 100,000 paths, and that would reduce the margin here in terms of error. Now we can do that in Excel using VBA. And as it turns out, I have some code in the developer tab, so we can go in and we have, again, it's a relatively crude version of what's in the spreadsheet or the worksheet, but we have a function here from mccall. Now I took this code and slightly amended the code, but a good reference here for all things to do with Monte Carlo and to do with modeling asset prices, modeling options is Espen Hogue. Espen Hogue's book. It's Espen Hogue's book, Option Pricing Formulas. It's a really good book, and it gives a very good overview of, and it's not too expensive. It gives a very good overview of how to use VBA, and it's a very replete book, and you get a CD as well with a huge amount of code. So strongly recommend this book if you're a VBA, if you plan to experiment with option pricing and use Excel. So we go back to our model, and I think this is one, and we look at our developer, right? And this is the function. So basically the drift as described before, if we just take these two, there's the drift, there's the volatility multiplied by the square root of t, the stock price, the terminal stock price, or the next stock price is the previous stock price, and then in the exponential we have the drift, and we have the volatility times square root of t multiplied by, again, application that's calling up the norms inverse rand. Okay, and then we have a bin that collects that result. So as we go through the loop, right, we have we're calculating the intrinsic value of the option, and at the end we take the average and we discount. So we take the number of steps, number of pathways in the tree, divide into the sum of all the paths, and discount, we get the value of the call. So we could implement that code and just see how does that also compare to Black-Scholes model. Okay, so let's push this over to one side. Actually, we can leave here. I can write the code here. So home and paste, and then I'd say equal to, and come down here, stock price 100, exercise 100, the time period is 1 year, the risk-free rate is 0.5, dividend yield we'll take as 0, and V is equal to the volatility, and then we must enter in a value for the number of iterations, the number of pathways, not the number of steps, the number of pathways. In fact, in this model here, there are no steps, just one step in each pathway. So 1,000, actually, let's make it 1,000,000. Okay, and hit return. And it takes a little while for the spreadsheet to compute, because we're doing 1,000,000 pathways, and we get 1045 if we hit that again. So 1045.7 is a bit different. Let's do it again. We'll get another result. Previously we had 1045.7. So I anticipate it'll be different again to 1040. So this time it's 1043, and again you can play around with that. Okay, so there's always a little bit with Monte Carlo. See Monte Carlo. Okay, there's always a slight amount of error. What's different between the code here and what we would have seen in the crude, less crude, this particular version here of Monte Carlo, the 1084, is here we have just 1,600 pathways. Okay, about 1,600, a little bit more perhaps than 1,600. But the way I implemented this model, we had 12 steps until maturity, whereas in the, if we go to the code, in fact, there are no steps. To create steps, we need a second loop. Here all I have is pathways. But when we ran the calculation in the spreadsheet, in the worksheet, and we go back into Monte Carlo here, this model, the way it's configured, all it essentially does is drive just one jumps, or just single jumps. So there's no steps. And then at the end you have 1,000,000 terminal asset prices, and from that you compute the average. So in the code there isn't steps. You basically just have the initial stock price and the stock price at the end of the year. and there's no steps in between. But that generates n pathways, and in the calculation we performed, we set n, the last parameter here, to be equal to 1 million. So we have a million stock prices, 1 million terminal stock prices or asset prices, from which we compute then the value of the call. If we run that again, we'll get another value. It won't be the same. It won't be 1043, or unlikely to be 1043. It'll be another value, but again, we would expect that it would be close to 1045, and in this instance, it turns out to be 1047. Okay, so in a sense, what we get here is this idea that the Black-Scholes model, if we look at some of the theory behind that, it's based on the notion that the asset price is a has a log normal distribution, that the behavior of the stock conforms to geometric Brownian motion. We could look at the behavior of a single pathway and hit F9. You can see we can simulate the movement in the stock price, and if we alter some of these values, we can make the behavior more variable. If we change that to 0, it becomes a straight line. If we change it to 0.2, the volatility goes up. And there is this random element that we capture in Excel using the norms inverse rand. The rand instruction by itself just creates a random number between 0 and 1, and the norms inverse imposes normality. Okay, and we did some investigation into what the rand was, some of its properties, and the norms inverse we also investigated by looking at its mean, which is close to 0, and standard deviation, which is always close to 1. And when we extrapolate these paths maybe 16, 17 times, we can see a fanning out. We can look at simulate different pathways. If we do more sophisticated analysis, we could increase the number of pathways to 1600. We find that, yes, that does produce values. We can estimate the value of the option, but there is quite a bit of error. And the way to reduce that error is to increase the number of pathways by a factor of maybe 1000. So in this instance, we performed a Monte Carlo using VBA, and we set out 1 million pathways. And even with that, there is still some error. So if I rerun this again, I won't get, we know the Black-Scholes is the true value. Black-Scholes is the theoretically correct value. And Monte Carlo is the value that we get using the simulation. It can be substantially different from the true value. Okay, but as we increase the number of pathways, that margin of error actually declines. So we don't get such a big discrepancy as we have here from 1045. We've reduced it. If we increase the number of steps to get the number of simulation pathways even more, we'll reduce the error between the true Black-Scholes and the simulated value of the European call option coming from Monte Carlo.